The Sleep Easy guy makes the final payment on his car loan. The balance reaches 0. The account says paid. Then his credit score falls from 760 to 735. He did not miss a payment. He did not max out a card. He did not apply for new credit. He did exactly what responsible borrowers are told to do, and the number moved in the wrong direction. That is not because paying off the loan damaged his finances. It is because a credit score is not a reward for good behavior. It is a prediction made from the information still active in a credit report. And when one account closes, the prediction can change even while the person becomes financially stronger. The strange part begins with what the score was measuring before the final payment. For 5 years, the car loan created a clean trail. Same account, same monthly obligation, balance moving steadily downward. Every on-time payment added another piece of evidence that he could manage an installment loan. An installment loan is different from a credit card. With a car loan, mortgage, personal loan, or student loan, you borrow a fixed amount and repay it on a schedule. A credit card is revolving credit. You can borrow, repay, and borrow again up to a limit. Credit scoring models look at both kinds of experience. FICO describes credit mix as one of 5 broad scoring categories. It is usually a smaller category than payment history or amounts owed, but its effect is not identical for every person. Before the final car payment, the Sleep Easy guy had 2 open credit cards and 1 nearly paid-off installment loan. That last loan was doing 2 quiet jobs. It showed an active mix of revolving and installment credit. It also showed an installment balance that had been reduced from its original amount to almost 0. Then the balance reached 0, and the lender reported the loan as closed. The good payment history did not suddenly become bad. The debt did not return. But the active pattern changed. He no longer had an open installment loan. The scoring model had less current evidence of him managing that type of account. FICO says its analysis has found that a heavily paid-down active installment loan can represent lower risk than having no active installment loan at all. So when the last active installment loan closes, some people can lose points. That is the first reveal. The score did not punish the payment. It reacted to the disappearance of an active pattern. Think of the credit report as a dashboard, and the score as one warning light. Paying off the loan improved the engine. It removed a monthly payment and stopped future interest. But it also changed one sensor reading. The warning light can flicker even though the engine is healthier. This is why the word score causes so much confusion. A score looks like a grade. Grades usually reward completed work. Debt feels like the assignment, so paying it off feels like earning an A. But a credit score is closer to a risk estimate. The Consumer Financial Protection Bureau describes it as a prediction of credit behavior based on information in a credit report. Lenders use that prediction to estimate how likely a borrower is to repay. The model is not asking, did this person make the morally correct choice? It is asking, what does the current pattern suggest about future repayment risk? Those are different questions. That difference also explains why the drop is not universal. Someone with a thick credit file, several active accounts, a long history, and low card balances may see little movement. Someone with only a few accounts may see a larger change because the closed loan represented more of the available evidence. The score can also move for reasons that happen at the same time. A credit card statement might report a higher balance that month. An old account might age into a different category. A lender might update the loan on one bureau before another. A person might be looking at a different scoring model from the one used last week. There is no single credit score stored in a vault with your name on it. Different models can calculate different scores from different bureau data on different days. The score in a banking app may not be the score a mortgage lender uses. Reporting time adds another layer. The final payment may leave the bank immediately, while the lender updates the credit bureaus days or weeks later. One bureau can show the loan as open while another already shows it closed. A card statement can update during the same window. 2 screenshots taken a week apart may therefore reflect several moving pieces, not one clean before and after experiment. This is also why the exact size of a drop cannot be promised. FICO publishes broad categories, but it does not assign every person a fixed 10-point reward for credit mix or a fixed penalty for closing a loan. The model evaluates a complete profile. A thin file with 3 accounts is not scored in exactly the same context as a 20-year file with a mortgage and several cards. So a drop after a payoff creates a timing clue, not a complete diagnosis. Our Sleep Easy guy now reaches the major reveal. His debt is definitely zero, but the 25-point drop in this hypothetical example cannot be explained by staring at the score alone. He needs to inspect the information beneath it. He checks all 3 credit reports. The car loan appears with a zero balance, closed status, and no late payments. His credit cards remain open. Their reported balances are low. There are no unfamiliar accounts, hard inquiries, or collection entries. That matters because errors are possible. A paid loan might be reported with the wrong balance or status. A late payment might appear incorrectly. An account might not belong to you at all. If the report is wrong, the correct response is to dispute the error, not to invent a strategy around a bad number. But in his case, the reports are accurate. The score changed because the data changed, not because the data was false. Now comes the dangerous temptation. He could open another small loan just to restore an active installment account. That would turn a measurement into a target. He would pay interest, accept a new inquiry, add a new account, and create another monthly obligation to influence a category that FICO says is relatively small. Even FICO warns that adding a loan merely for credit mix may not be worth the risk and cost. This is the second reveal. A better score is useful, but borrowing money solely to manufacture a better-looking file can leave you poorer. The financially stronger outcome is often the one the score does not celebrate immediately. The sleep-easy guy no longer owes the car lender. His monthly cash flow improves. His chance of missing that payment becomes zero because the payment no longer exists. He can redirect the former payment toward an emergency fund, another debt, or a future car replacement. None of those gains is fully captured by one score movement. That does not mean credit scores are meaningless. A score can affect approval, interest rates, deposits, and other decisions. If he plans to apply for a mortgage next month, a change deserves attention. If he is not applying for credit, the same change may be mostly noise while his underlying finances improve. The useful question is not, how do I make the score rise today? It is, what decision is this score preparing me to make? That leads to a simple, practical tool: the report, model, timing check. First, check the report. Confirm that the paid loan shows a zero balance, the correct closed status, and accurate payment history. Look for changes elsewhere, especially card balances, new inquiries, unfamiliar accounts, or incorrect late payments. A score is calculated from report data, so the report is the evidence. Second, check the model. Identify where the score came from if that information is available. Do not compare 2 scores as though they came from the same calculator when they may use different models or different bureau files. A difference between models is not necessarily a change in your behavior. Third, check the timing. If a major credit application is close, avoid unnecessary new accounts and keep revolving balances controlled while you verify the reports. If no application is near, continue the behaviors that matter most. Pay every bill on time, keep card balances manageable, and let accurate positive history accumulate. The tool is deliberately boring. It prevents a temporary score reaction from provoking an expensive decision. There is one more detail that makes the ending less alarming. Closing an installment loan does not usually erase its entire history overnight. Positive paid-as-agreed information may remain on a credit report after the loan is closed. The account can continue showing that the borrower completed the obligation even though it is no longer active. So the final payment changes the file, but it does not convert years of responsible payments into failure. The sleep-easy guy returns to the same dashboard a few weeks later. The score may recover, move sideways, or change again as new balances and updated reports arrive. He cannot control every calculation. He can control whether the underlying file is accurate and whether his real financial position is improving. He keeps the loan closed. He keeps the payment for himself. And he stops treating a risk model like a moral grade. Paying off the loan was not a mistake. The score drop was a reminder that financial health and credit scoring overlap, but they are not the same thing. One measures a lender's estimate. The other includes cash flow, interest avoided, fewer obligations, and the freedom created when a payment disappears. If a score ever dropped after you paid something off, what was your first reaction? Share the feeling, not the number. And if calm explanations of strange money systems help you sleep easier, subscribe.